Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about 5 things that could affect your portfolio in 2022. And I talk to a lot of you on a daily basis, and a lot of you have a lot of concern, rising interest rates and inflation, and how's this all going to affect my portfolio? So today I thought I'd bring on Chris Richard from BCV Asset Management. BCV is one of the portfolio managers that we refer clients to. My own personal money is invested at BC and has been for many years. They do a phenomenal job. Every company that they own pays a dividend and has a history of increased earnings and dividends. So if you have any future video content for Chris or any questions, put them below and Chris will answer them, or we'll actually make a future video on the question as well. So thanks for joining us today. Let's jump into it. Okay, thanks so much for joining us today, Chris. We really look forward to this content. I'll let you jump right into it.
Sure. So the first one really is going to be inflation. Inflation is everywhere. It's a tax on everybody. There's no way to avoid it, only because there's not a segment of the society that doesn't buy some type of good that has gone up a tremendous amount in value year over year. At the beginning of the pandemic, prices kind of got collapsed mainly because everything was shut down. And when that happens, you have this thing called the rebase effect, meaning that prices were way down. Now we're back up to normal. So you're going to have higher inflation. That's played through already. So now bottlenecks and restarting a global economy has really kind of been harder than what I do believe most people thought. And what's happening is it's now getting somewhat baked into expectations, which is not really what you want to have happen, because people's transition their behaviors. Now, over the next 6 months, 50% of businesses expect inflation to be north of 5%. That is way higher than what the Bank of Canada, as well as the Fed in the US, want it to be. They want it to be around 2. Now, cynical people would say, middle of the pandemic, when you're giving out a lot of stimulus, which was needed at the time, we were always going to inflate our way somewhat out of this problem of spending all of this money and then needing to get some of that money back, right? So as we kind of have higher inflation, the tax rolls should be elevated. People might say that that was the reason why they did it in the first place. But we also wanted the economy to get what's known as escape velocity. Escape velocity is really when the economy doesn't need this accommodative support. The new variant of the virus maybe has delayed or pushed out a couple of months, or even brought forward, depending on the way you're thinking of it, as to where we're going to get back to more normal, policy. But what's happening when you have inflation that's been here for a long period of time is it starts getting baked into individuals' wages expectations. So you're starting to see this in the US quite a bit, where individuals are saying, like, listen, everything I'm buying now, I go to the grocery store, it's more. I'm going to rent a car, it's a lot more. I'm going to the lumber yard, and it's a lot more. All that type of stuff, people say, like, listen, if I want to stay where I'm at to be able to buy the same amount of goods next year as I do this year, I got to get at least, 4, 5, 6% to keep up, right? So at that point, you're starting to see, everyone starting to get higher wages. And as you have higher wages, then you have more money chasing fewer goods, right? So then it kind of gets this snowballing effect, which is not really what people want. Also starting to see is there's a hard time finding staff, to be quite honest with you. We seem to be almost back to where, at least in the US, where people would consider to be fully employed. But at this point, when you have a short-staffed situation and people are saying, I need more money, so you're going to have to pay more people, but there's less people out there looking for jobs. So again, that snowballing effect. And it's also on the demand side. People are looking for goods, and a lot of businesses, because of the issues that we were chatting about, aren't having enough people to satisfy the demand that is there. So inflation is something that is going to be kind of almost a cause to what's going to happen, which is our number 2 point, which is central bank policy.
So we just booked a trip to Calgary to visit my sister-in-law in May, I think it is. The rental car, a van, it's $350 a day for rental. Yeah. I was like, you could rent a van for under $100 a couple of years ago, and now we're looking at $350 a day. So if anyone's in Calgary and has a van, I need it in May. So there we go.
So the number 2 issue that we kind of see is almost the response to the number 1 issue, which is inflation, which is central banks around the world kind of getting back to normal, right? In 2022, we do expect the Bank of Canada, as well as the US Federal Reserve, right? They're going to start raising interest rates. In the US, people are expecting 3, perhaps 4 interest rate hikes. In Canada, it might be even a bit more than that. What happens when you raise interest rates like that, it usually puts a bit of a brake on an economy, mainly because, we are at having inflationary issues that we need to somewhat get under control. Back when, in March of 2020, we went to the most accommodative policy possible. We went to as near to zero as we can get to. We're no longer in that time where we need that accommodative stance. But when you close an economy, guess what? When you bring interest rates to zero, no one cares, right? Someone wanted to open up a business. You couldn't open up a business because the economy was shut. So what they had to do is what's known as quantitative easing, which is in essence code for buying assets. So what they did is they bought assets to bring down the longer term interest rates to make it more affordable for individuals to buy a house, finance a business, anything that's related to credit needed to kind of have that has an interest rate attached to it. They want to bring that down to make it more accommodative for you because it was tough slogging out there. But again, we're in a completely different time right now, and central banks around the world do have an elevated balance sheet, right? They've bought a lot of assets, and right now we're starting to see like perhaps it's time to not only just let them somewhat run off naturally, but some people are saying maybe it's time to get a bit more aggressive and let's speed up the amount of liquidation that we have of the balance sheets of central banks around the world. So the Fed and Bank of Canada policy response is something that could definitely impact your portfolio in 2022, mainly because we don't want to see them make a mistake. We don't want them to go too fast. We also don't want them to go too slow. But here's the thing, we've never done this before, right? Mm-hmm. Or very few times where we've actually kind of really shut down an economy and then revived it. So the chance of a policy mistake is elevated. And when those mistakes happen, those could affect your portfolio, in 2022.
Yeah. And I think when I talk to people, I think that's the biggest concern people have is how fast and how high, I guess, the rates get raised. Like, are we going a quarter point? Are we going half, 75? Are we going to be a full 1 point?
Yeah. Some bank economists are calling for like incredible growth in the short end of policy rates, only because they see the potential for inflation really to get ingrained here. People are saying that it'll be like 1.25 in the US for sure. People are calling Canada perhaps even more aggressive than that. The direction of policy is to be hiking than loosening. That's definite.
So you're saying I should have gone a fixed rate, not a variable on my mortgage that I just renewed at 1.35.
So the number 3 thing that's going to probably affect your portfolio is it's going to be rising interest rates. Do I see us getting back to the days of like 5-6% on 10-year interest rates? I don't, right? I mean, there's still a lot of deflationary factors that were affecting interest rates prior to COVID that are still overarching. So as we get back more to normal, rates should go a bit higher. So on the screen, we have a chart of some major economies around the world. And this is the 10-year interest rates. So they're not crazy high today, but they could be, a bit higher, 3 months from now, and a bit higher 6 months from now, and a bit higher a year from now as we get, again, back to normal. We're going to have GDP growth that's pretty robust. So we should have, longer term interest rates that are higher than, in my opinion, than what they are right now. So how does this affect your portfolio? In bonds, it's more of a linear relationship. As interest rates go up, face value of your bond should come down. And it's more pronounced the further out the tenure of the bond is. So if you buy a 30-year bond and interest rates go up, it's more impactful to the face value today. On stocks, really what you're buying when you're buying a stock, it's the cash flow from that business discounted back to today. And when you have interest rates going up, what that'll do is it'll make the share value today worth a bit less. So if you kind of talk about a company that has cash flows further out, and we'll chat about that later, the impact to today in that share price could be a lot. I don't think that it's a reason to completely abandon an asset class, mind you. I just think perhaps you might not want to be buying ultra long bonds anymore if you were before. Perhaps keep the duration or the time to maturity a bit shorter.
And this is one of the risks with bond funds. I always tell people, a lot of time those bond funds are holding long-term bonds. There's not a lot of bond funds I've seen personally on statements for the last year up to 2 years now that are actually positive. Most of them have lost, 2 to 5% on average the last few years. And one thing I love with BCV and why my money is personally at BCV is you guys own individual bonds. You don't buy a bond fund for clients. You're buying individual corporate bonds within a client portfolio.
Number 4 thing that will impact your portfolio in 2022, in our opinion, is valuation. We are coming into 2022 with we don't think that the world's going to fall off a cliff like we were saying before. But, what we're seeing now is interest rates meandering a bit higher. And as that happens, stock prices might react negatively because, like I said, you're discounting at a higher rate those cash flows. So as you can kind of see, the top box there is S&P 500. The bottom box is the TSX 60. The S&P 500 is dominated by, very, top 5 companies represent quite a bit of the S&P 500. A lot of them are highly valued tech companies, right, that are trading at multiples of 20, 30, 40, 50 times earnings, which, I mean, they're great businesses. However, as you get interest rates going a bit higher, perhaps the true multiple that they should be trading at is less than that. So as the interest rates go higher, we might see valuation come down. I mean, we're starting at a fairly lofty price to earnings ratio. Could it stay there? For sure, right? It totally could. But we think that there might be a bit of pressure on that valuation, specifically as we're starting at an elevated rate. Here in Canada, you can see the TSX 60, it's dominated by different types of businesses, right? You're kind of thinking like banks, oil and gas and pipelines, those types of things. They don't trade at the same multiples as the US companies. So you're not going to have that starting point that is so elevated relative to the US. But we really want to be careful that when you're buying securities within your portfolio, that you're not paying too much at a starting point. And if you pay too much, you might have to just sit there and let that time kind of grind off that extra multiple that you paid for. Same thing we were saying is like people say, oh, this thing traded at 50 times earnings 2 years ago and it's trading at 40 now. What a value. We were in an incredibly accommodative policy, a year ago. So perhaps, the true multiple that stock should trade at isn't even 40. Anyway, it might be, 20, 30, right? So you might be getting a discount from the peak, but just because it traded there doesn't mean it should trade there.
As we've seen over the last 2 years, you can have a high P ratio on a company that can continue to run. I mean, case in point is 2 years ago, Tesla. I thought it was overvalued then. I remember about 6 months later, my cousin texted me. He's like, hey, what are your thoughts on Tesla? I said, I don't know. I thought it was overvalued a while ago. I still think it is, but it continues to run. So there's always going to be these phenoms almost that keep running. But at the core of investing and people that are watching this video, I think what Chris is saying is overly important of, don't get caught up in, it was 50 2 years ago and it's 40 today. So it's on sale. That's not necessarily the case.
To be honest with you too, like some stocks, depending on the fundamentals of the business, should trade at a higher multiple than other businesses, right? If you're a SaaS technology company, you're going to trade it at a higher multiple than, say, a big commercial bank. Sometimes traditional value managers are saying, you can't buy anything that's more than a 10 times, PE or company. For the most part, we want companies that are solid, that are run by great people, that aren't broken, and that are winning. And when you kind of check all those boxes, usually you're not paying 10 times earnings for a business. The number 5 thing that we think is going to impact your portfolio in 2022 is perhaps a rotation to more of a value focus. This is kind of the culmination of everything that we've been chatting about. The first 4 factors, we think as we start seeing interest rates going higher because inflation's higher and central bank policy, right? We're going to start to possibly see a rotation from selling really, really high valued stocks to perhaps something that is, a bit more of a value investment. And the reason for that, it's kind of back to what we were saying before, the business that you're buying might be great. And the trajectory of that business and with the results might be the exact same. But if say you're buying a company that's a unicorn and it's going to be cash flow phenomenal in 10 years, those cash flows out 10 years discounted back at a higher rate mean less today, right? So that share price will come down. So when you kind of see that selling off, perhaps sometimes you might see your rotation to more of a value focus. So I've charted here the white line with the blue in it is the growth ETF by Vanguard, as well as the blue line at the top there. That is the value index. Right? We started to see this rotation out, a couple times throughout the year, but it seemed to really grab hold, here in 2022. BMO's done a really great analysis and said, like, listen, in 2022, if you kind of break and chunk stocks based on how, expensive they are, in 2022, the ones that have sold off the most, they're the most expensive, right? Kind of the same thing that we've somewhat seen. People say, okay, Chris, well, you're depressing me here. Like all of a sudden, nothing makes sense. I can't buy any asset classes, right? What am I going to do? Just because we're raising rates and because all this stuff is kind of happening doesn't mean you're going to have a negative response, right, within your share price. So BMO, again, done great work on this. They said, like, listen, the last Fed tightening cycles, specifically in the US, hasn't been doomsday for your portfolio. You have to be really specific and cautious on what you're buying and what you're paying for these stocks, right? You really want to know what you're holding and what you're paying for what you're holding.
And that's one thing, I always tell people, over the last 10, 11 years that I've been working with you guys, is that's one thing that you guys continue to avoid year over year is making that big mistake.
Yeah, I appreciate it. I mean, we're obviously not immune to making mistakes, right? But we just want to limit those, right? So when fishing upon really high quality businesses, really large businesses that are run, here's the thing, you're run by phenomenal men and women, right? So all those types of businesses sometimes get rid of the outliers of small companies where you have that home run or strikeout philosophy where it's like this thing's going to triple in 6 months, or it's going to be worth zero. For our clients, this is their forever money that we manage, right? This is their serious money. This is their retirement. And we take it with the respect that it deserves. What I see a lot of, individual, portfolios when clients come in that are DIYers is sometimes they don't let the thesis play out. They're saying, oh, if it hasn't gone up in, 3 weeks, then it's a dud. That's not the way investing works, at least not in our opinion, right? The time in the investment really is important. And we really want to make sure that we buy companies that have got good, strong fundamentals, that have got a track record of success. And we think they got another bright future ahead of them, which is why we like them.
Well, Chris, thanks so much for joining us in this video today. We really appreciate your time. I'll put all of Chris's info below, link to BCV as well. Check them out. If you have any questions on BCV, reach out to myself, info@parallelwealth.com. There's also information on our website, which we'll link below as well, which is parallelwealth.com/investment. So thanks for joining us in this video.